Okay, I've got some vocal here, and I am a little bit early, so I expect I'll have some of you who come in. Those of you who do, don't worry about it. Hi, this is recorded, and so I try sometimes, if it's possible, to start a little bit early. I've got a couple of things I need to get done today, and I know all of you sometimes like it a little bit early, so you can go eat or get over to classes a little bit early. So you won't miss anything at all. uh, those who would come in. And let's see what we got so far. Okay, I've got Audrey and Trevor, and if you would please, I'm going to mute your devices so you can't hear. I mean, I'm going to your microphones and your videos. So we've got that done there. Now, I want to go over into the announcements area and just some housekeeping stuff just to make it sure that everybody is on the same page. You're going to see each week in the announcements section of Canvas, I'm going to put, you'll see 3 types of announcements typically. One will be an invitation. And for the 2 of you who are online, you follow that invitation to the class here today. So you see there's an invitation for today, and then there's one for Thursday. Now, when I'm finished with class today, I'll take the screencast, which I'm recording, okay, and I'll convert it to an MP, to a file that I can upload at YouTube, and then I'll load the YouTube file in the announcements. So if you want to see the recording of the session, go ahead. So that's something I want to make sure everybody understood. For example, here is, of course, a recording from the 1st of February. Now, that's a housekeeping piece that I want to cover and to make sure that everybody knows that. I want to go now over to the modules. Okay. And I want to talk some about what we've got going on. Now, in week 0, we just kind of had a course intro, excuse me, and we previewed Guardian Roofing, which is XLS3. And everybody should have uploaded Guardian Roofing XLS3 that should already be done. Okay. And then, if I'm not mistaken, we also covered cases 1 and 2, and I showed everybody the files used. And if you're not sure, this document, okay, will tell you the files that you can upload for case 1 and case 2, both of which are due the 8th. Now, case 3 is due a ways down there a ways. It's due on the 15th. You say, why are we doing this? Well, as I've said before, I treat these access, we have 13 Excel cases, we have 6 access cases, and I use them like a workshop, okay? I go through a solution. I save you a lot of time of inputting data and all this. We dispense with stuff like formatting, which you all know, and it lets me get to the heart of the technique we use in that case, plus the business, the business problem that's embedded in the case, because this course is designed to expose you to using Excel and some of its advanced components, access, but also to introduce you to some fairly typical problems that companies run into. So we covered XLS1 last week and XLS2, and those were whistle cleaners and Athena beauty products. And so you know, I had this Tyler doc tells you where those are at, and they're over in the files section. I'm going to open up this for just a minute. It'll render it up. It will tell you, okay, okay. You'll find Athena Beauty and Athena Beauty and Athena Whistle Cleaners. You'll find those over in the files. So let's go back here for just a minute. And we'll go on the files, and we'll just do a quick search, and we'll look for Athena. And this is XLS case number 1. And I went over to have some things about formatting and resizing columns and stuff like that. And we did some numbers, and I showed you kind of ideally how it looks. So that's one of them. The second one, okay, is whistle cleaners. In fact, whistle cleaners is the first one, and Athena Beauty Products is the second. So now, if you have your book, you should each time go over to page 25, okay, and that's where that case starts. Whistle cleaners. And remember, we were developing a client tracking system to determine when they should be contacted and all that business. And so I had kind of gone through that. Also over on page 29 in the text, in the Solve It text, okay, we talked about the design, okay, of a worksheet. And there in figure 3.1 on page 29 of the Solve It text, it walks you through the title, documentation, the assumptions, input, and calculations and ranges, okay? The major sections that ought to be in a well-constructed spreadsheet or workbook. Now, Athena Beauty Products was a little bit different, and we'll look at here, and let's open it up for just a minute. Okay. And here's what we did. Okay, we had the skeleton file. If you want to see the skeleton file, it's over there in Solve It student files. Okay, and then there's the set of answers files. And over time, as I've taught this class, I've kind of embellished and worked on them. And so this is kind of the latest iteration. But as you recall in this, okay, we were looking at the source, the visitors, the shoppers. So we took the shoppers, visitors, and the number who became shoppers, and then we got that percentage. Then we looked at those who are attempted buyers. And those are people who were shoppers who became attempted buyers. And then we took shoppers, converted to attempted buyers, the percentage. Then we took the number of people who were buyers, okay? And we looked at and we got the percentage of buyers. We got the percentage of attempted buyers who actually made a purchase. Then we did some visitors who purchased per website, and then the percent total of visitors by source. And so we did some work there with some of the we just did some simple formulas, okay? And that's Athena Beauty. And that's the second case, that's XLS2. So you ought to upload both of those, okay? Or if you uploaded those files already, you're good to go. And of course, we did, we looked at Guardian Roofing Payroll, okay? So you've got that one uploaded there. You said, oh, why are we, okay, you say, okay, I understand you're showing us this and keeps us from having to do a bunch of data input. Let's just talk about the business problem and all that business, right? And it's a workshop, okay? And the whole purpose of this is we'll blow through these Excel cases pretty easily because all of you have had quite a bit of experience with Excel, especially if you took BISS 1103 with Dr. Marimi or maybe Mrs. Corley. You took that 1103 course, you emphasize that. Then we had, of course, we've uploaded also XLS3. And we're working ahead in here because when we come to when we get to the access portion of the course, things will slow down because you haven't had the experience with access. So I'm trying to build some slack time in here, flex time, so that when we get ready to work with the access cases, it doesn't have to feel rushed, and I can spend some more time on getting you comfortable with it. And I'll take a look here for just a second. I see you got 9 others out here. I'm glad to see you. Alyssa, Audrey, Brad. Let's see, we've got Hayden. Looks like Ashley, Hayden. We got Sam, Trevor, Cassie, Matt, and Matt. Thanks for being here. Now, the bottom line on this is, as we work through, I want to focus on the business problem more so than just spreadsheeting techniques. And if I were you, as we do these, before you upload them, I'd send them myself an email. Okay, so you kind of have them there for yourself to look at. Now, at the end of this week, we have 3 things due. Those are all due on the 8th. Okay, the financial ratios quiz, XLS2 and XLS1. These should have already been uploaded, XLS1 and 2. The financial ratios quiz, you asked me, what is it about? Well, the financial ratios quiz is drawn from materials that I have here in Canvas and also over at the supplemental website that deal with financial ratios. And then it's also based upon case number 4, which we're going to talk about today, which is Dabney Financial Services. Now, you really should always have your textbook with you, okay? Because that's how you get the maximum value out of the case study, and your understanding, where did I get the numbers and put them in. And over on page 47, they walk us through a Dabney Financial Services. They start that process, okay? So that ought to get us going. And I'm just going to take some time and go through it. And this is a case, okay? And this case is a big chunk of material, important piece of material to you, because it's also what you can be using for the financial ratios quiz that's going to be coming up, that's due on the 8th at 5 p.m. Okay? So you'll want to, and that's going to be Thursday. So you'll want to have that, and the exams, those quizzes are open book, open note. Okay? So that'll get you started there as we go. Now, I want to take a couple of minutes now and just talk about the case number 4 and the Dabney Financial Services. And you're going to notice that as you go through these cases, every single time it starts with the problem, management skills, Excel skills, and then they give us some information about a company that's involved, and something that some task or issue. And if you look at page 48, you're going to see it starts with all of the ratios, the types of them, the liquidity ratios, asset management ratios, debt management ratios, profitability ratios, and then over on page 50, the market value ratios. So if you want to know how to compute them, okay, they're all there. All right, and you'll want to take a look at that, and will be really, really helpful to you as you go through a quiz, the financial ratios quiz. Excuse me. Okay. Well, we're going to look at Dabney, and what's going on is this case is about a company. Pardon me. Over on page 50, they give you the 5 tasks, 50 and 51, to do. Okay, and then some additional problems. Here's the deal. All right, this case is about a financial services company. They have a client, and they have been asked to make a recommendation on a stock purchase. Which one should the client buy? CVS, okay, or Walgreens. I see a question here. Just a second. The quizzes, some of them are timed, some of them are not. You'll just have to look at it quiz by quiz to see. Okay. Now I'm going to pop this open for a minute, and it's 50 points. You get 2 attempts. You have 20 minutes. It's pretty simple. And if you have the book open and you do a little bit of studying and you paid attention in this case, you should be okay. So I think it's 10 items, if I'm not mistaken. So you'll just have to look at each one of those as you go along to see. The quickest and easiest way to do it would be to go over into the syllabus area, okay, and to take a look at when things are due. And then when you click on it, it'll give you, it will give you details, you know, about how many items, how much it's worth, that type of stuff. Okay. Now on a timed quiz, you know, you get I think you get 2 attempts. It's 20 minutes. What I mentioned is this. Okay, there are 2 things. Number 1, case number 4, which we're going to look at today, that deals with financial ratios and how to compute them. And if you have the Solve It textbook, if you start on page 48, 49, and 50, you're going to see all the different types of ratios, how they're calculated, the formulas for them, why they're important. I have some other material in the website that talks about the financial ratios and all that, but the heart of the exam, okay, is going to be over here in case number 4. Okay, now let's go back to the modules for just a second. And so if you say, is case number 4 drawn, the exam drawn off of case 4, the quiz? Yes, it is. You'll find just about everything you need to know in there, especially how to compute stuff. Okay? So that kind of gets us set up for doing that. Now, we're going to look at case number 4 today, which is Dabney. And as I was saying, we're going to compare 2 stocks, CVS and Walgreens. Both of them are retail pharmacy companies. Okay, so they're in the same industry. They're considered competitors. And so we've had a client, Dabney, the financial services, has had a client come to them and say, which one should we buy? So we're going to do some analysis of those 2 companies' performance. Now, one of the reasons that we use accounting ratios, and let me stop here for a minute, because I think, if I'm not mistaken, I have a file in here on accounting ratios. Yeah, it's called A Short History of Accounting Ratios, and it gives you some perspective in terms of why and how companies came to use these ratios. Okay, and let's go back here to the files, and since we're over here anyway, okay, let's look for Dabney, and you'll see this file, Dabney case Excel case 4. All right, now what I want you to do is download this case to your computer. Okay, and here's the reason. When we open up these files in Canvas, okay, they're system files. All right, and so there's not an assumption in that sense that we are that it's a real file. So what we have to do is take the file, save it on your desktop, and then you may need to rename it. Okay, because once you put it on your device, whether it's your tablet, your desktop, once it's saved on a device, then the system will accept it when you get ready to load it back. In fact, it's probably not a bad idea to go ahead and do this. I'll just give you an example. I have this file right here, and I'm going to save it as an Excel file, and I'm going to put it on my desktop. In fact, I'm going to call this Excel, and I'm going to put my last name on it, and I'll save it on my desktop, and now I'm going to close it. Okay, and then I'm going to come back, and I'm going to open it back up. Okay, it's going to open itself up now, and Now I'm going to close it for now. Once I've done that and then reopened it, I would rename it. You could once you save it to your desktop, and then you could rename it there. But you'll get out of the you'll get out of the problem that gets created when people just open the file, okay? And they think they're working on a real file. It's really just a rendering. You've got to save it to a device before it's going to be a real file, okay? Now there are some things in this finished product today that I want to show you that are going to be some ways to help us be a little bit more efficient and more effective in working with our spreadsheets. And it lets us also take a look at this issue of accounting ratios. Now the reason that we use accounting ratios is to wash the data that we get about a company, okay? This case today is really about three things. Using the name manager function, and I'm going to show you that and I'll show you that when we get into the case. The other is the types of financial reporting and how they differ and why. And then we're going to talk about using accounting ratios. Ratios we can use them to wash or clean data so we can make comparisons of companies. Let me give you an example. Let's say you have two companies that sell. I don't know. Let's say we have two. Let's say we have two companies that they sell the same product. Okay, they're in the same industry. One of those companies, okay, has $100 million a year in sales, and so they set their goal for the next year to have a 10% increase in sales. Well, that means they're shooting for $110 million in sales. Pretty simple math. But then let's say we have a $1 billion company, a firm that has $1 billion of sales. Now we're talking about if they do a 10% increase in sales, we're talking $100 million. Big difference. So we use the ratios, okay, to normalize these numbers. It's just like maybe you studied math back in high school. Maybe you've studied it here about logarithms, where we convert them back to their basic form, and then we can compare companies. We compare them on the basis of those ratios. Okay, so that's a key part of this whole thing. Now, I want to go through what we're looking at, and the textbook does a wonderful job starting over here on page 48 to explain to us the different types of ratios. The first is the liquidity ratio. Those ratios tell us, does a company have the cash on hand to do business? Okay? If you don't have any money in the bank, you can't do business. The second are what we call asset management ratios, and those ratios tell us how well have we used the assets that have been put into the company. Okay? Then we have the debt management ratios, and those ratios are the ratios that tell us how well we have utilized debt. Okay? Are we too leveraged or not? Could we stand to borrow a little more money? And sometimes a company can. Have we borrowed too much money? Sometimes a company would do that. Or are we just about where we ought to be? Okay. Then profitability ratios. And at the bottom of page 49, you're going to see those. There are three of them. It's return on assets, and that's net profit after taxes divided by total assets. And that says, what are we getting for the money we put in the company in terms of profit or return? The return on equity, and that's net profit after taxes divided by net worth, or the equity, the firm. That's the equity. That's the shareholders' equity that they put in. Okay. Then lastly, we have the profit margin. That's net profit after taxes divided by sales. So we ask ourselves, for each sale that we make, how much profit are we generating? Okay. And then over there, finally on page 50, the market value ratios. And that's where we look at we look at a ratio where we take the price per share versus the earnings per share. Now, If I have a stock that sells for $100, okay, and I get $10 back in dividends, or $10 in dividends plus the growth in the equity growth, that is the value of the stock goes up, I'm getting a 10% return. If I have a stock that I pay $20 for, okay, then if I'm getting 5 or $6 a share, I'm really doing well. Even though I have a cheaper stock, I'm still on a percentage basis, it's outperforming the other. Okay, although when we get to scale, things get a little bit rugged or get a little bit different. You say, what do you mean? Let's take a look over here at this file for a moment, and I'm going to look at cell B4, B15, and then B16. And we're comparing these two firms, CVS and Walgreens. Okay. And remember now, I'll just go back through it real quickly. We have the title section of the worksheet. Then we have the documentation section. Then we have our output areas and calculation areas. Okay, so we don't really have any assumption areas per se this time. But if you look at CVS and Walgreens, now these are old data, but you know, it doesn't matter, you know, the time is just so that you understand those ratios. That's really what matters the most. And here we've got CVS and Walgreens, and look at this. Walgreens has about 50s or these dollars are in thousands, pardon me, in millions. And so Walgreens at this point is doing about 59 million a share. Okay, and Walgreens 87 million. Okay, so CVS has a lot bigger, higher sales. Okay, so we might say, well, that looks like to me CVS is the choice. But the question is how well do they handle the sales they generate? How much debt did they use to do that, or how quickly do they get their money collected? All kinds of things. So it's kind of a misnomer. So we have to walk through these. Now you're going to see the very first set of these are the income statements, and we're going to take just to kind of look at what we call the financials. Okay. Now understand, when we work on a tool like this, it's called a pro forma. Pro space forma, F-O-R-M-A. It's a Latin word meaning for the sake of or for the form of. It's a pro forma. This is a management tool. Okay. And here we have the income statement. Income statements are longitudinal in nature, meaning what is the income between, you know, 1 week to the next, 1 month to the next, 1 quarter to the next, or on an annual basis. It's longitudinal. Okay. Income statements tell us, you know, how much we did in a particular year or whatever. Then we come down to these things called the balance sheets. The balance sheet is a snapshot of where we are right now. They're designed to tell us the position of the firm at this moment. Okay, so we have one that looks at performance over a period of time. That's income statements, and then we have the balance sheets that they're a snapshot of the company at that point in time. So let's start to kind of walk through this, all right? And as I mentioned, one of the key tools that we're going to learn here today is the name manager. So I want you to click on data, pardon me, on formulas. Click on the formula tab, and then come over and you'll see a thing called the name manager. And let's open this up. And you're going to see all of these here in the name manager box. And what we've done is for these different cells, okay, we have given them, we've designated them as a particular variable. For example, okay, and B50, okay, is CVS current assets. And we also have the value that's showing there. And you say, why would we do this? What's the point? And it is a lot of work. But in the long run, you'll save yourself a lot of time, because what it allows us to do, okay, is to use these in equations. So rather than sitting here and trying to figure out what's E19 and what's D58, if I know the ratio, if I know the two variables, I relate them in a particular way. And I'm going to show you, I'm going to click on, I'll show you real quickly. Let's click on E20, okay? And I'm going to define I'm going to make this 20. All right, and then I'm going to come up here and click define name. And I'm going to call this the 20, I don't know, let's just call it, I don't know, Chris, let's just call it anything. I'm going to call it Harmon. Okay. Now, if you look at this right here in the new name box, it says Harmon, and I can apply the scope of it to just this worksheet or to the whole workbook. And then it says down here, it says it refers to Dabney underscore, it refers to equal Dabney underscore Q, and see the exclamation point? That means a worksheet. E20, and notice that the E and the 20 both have a $sign in front of them, which means that's an absolute cell reference. Okay, so I've got Harmon, and then down here I'm going to come down to cell E21, and I'm going to put 10 in here, and then I'm going to come back up and I'm going to define the name. And I think in the name, I'm going to put, I don't know, let's call it, I don't know, let's call it Keith. Why not? And then again, is it apply for the workbook or the spreadsheet? It applies to the whole workbook. And then notice down here it says refers to equal Dabney underscore Q, exclamation point, meaning the Dabney Q workshop. E21. You got that? So now if I want to do a calculation, okay, of the value of my last name relative to the value of my first name, or whatever you've put in there, I'm going to go equal, and then I'm going to click using a formula, and I'm going to come down here, and they're all arranged alphabetically. I'm going to put Harmon, okay, and then I'll put in the operator to divide. And then I'm going to come back up to using formula, and I'm going to find Keith. All right, and I'll click, and I get 2. The nice thing is that it over here in cell F20 where I put this, you can see the two variables, the names, rather than a cell. All right, after a while, B28 becomes a little meaningless. But if you use the cell reference, if you use the name manager, you eliminate all those kinds of problems. And trust me, you're going to be working in, especially if you're finance students, you're going to be working in spreadsheets very, very long, and you'll say, I'm so glad I learned this and that I do it. Okay, so the name manager lets us define that name. Okay, now, right now here, the 2 is displaying, but if you look up in the formula bar, you'll see it's Harmon divided by Keith. Or if I click on E21, you'll see that it shows the 10. It shows me that value. Okay, then up here the same with the value. And if I'm wondering what in the world is this, I can always go back up here and look for Harmon and the value, or I could look for Keith and the value, okay? And here I use the names in an equation. This will save you a lot of time, all right? Now, I'm going to X those out, and let's talk a little bit about, we've got the income statement, and then we talked some about the balance sheets. The income statements, as well as the balance sheets, start us from current to long term. Okay, let's look at this for a moment in terms of the income statements. here we see, and we see for both firms, CVS versus Walgreens. So this is prettied up. I could put some borders and stuff like that in here. If you do, fine. I don't care. Okay. It does give us. It does give us, maybe it might help us a little bit more, but this is pretty clean. Okay. Now, I've got the income, and I start with net sales, i.e. revenues. All right. And we got them for CVS and for Walgreens. Okay. And then the cost of sales, often known as the cost of goods sold. And we subtract that from our sales, and we have our gross profit. Then we see if we've got any other income. And then net interest. You say, wait a minute. No, this is interest they earn on their investments. A company can invest in other companies and earn money that way from those investments. And so we look at that, and we see that CVS lost $509,000 in terms of net interest. Then we get the gross income. Now, let's look at the formula here. And you'll see it's B17 to B19. If I go over here into column C, I'm going to see it's C17, the sum of C17 to C19. Okay? So I'm always, in this case, when I have a calculation like this, it's simple. I can just simply create the first one and then drag it on over. Okay? Now, I'm down to the gross income, okay? Then I want to look at current, and this is current expenses, okay? And I've got the selling and store operation expenses, any opening costs, any losses from discontinued operations, any interest expense, okay? And so we have the total expenses. So now we're ready to calculate the income before tax. I'm here in cell. I'm in cell B30, and you say, Dr. Harmon, would it be possible to define that name? Yeah, as long as I've defined the name for all of these, okay? And we've got those in there, but I chose not to use them. But we're talking about B20 to B20 minus B20, B17. B20 minus B27, excuse me, okay? And so we take gross income less expenses gives us the income before income tax. Then we do our income tax, okay? If I'm not mistaken, I think this probably assumes a tax rate of 40%. You know, as you've been following the tax law, the new tax law, corporate taxes will be at 21%. Okay, so here's the income tax expense for both. Then, did they have any discontinued operations? CVS did. Walgreens did not. And now we're down to the net income. Okay, the take-home pay of the, if you will, of the company. Now we're ready to go here and take a look at the average number of shares outstanding. When companies issue stock, we always want to keep an eye on how many shares of stock they've issued. The more they issue, typically, the lower the cost of the lower the price of the stock. Okay, and so we look at that, the average number of shares that are outstanding, because it changes throughout the year. So we just get the average, and then we look at the earnings per share. Okay. Those earnings this typically refers to dividends that are paid. But there are really three ways that a stock can grow in value. One, the price of it goes up, even if there are no dividends given out to shareholders. Or the price stays the same and the shareholders get a dividend. Or the third, which is the price of the stock increases, okay, the market values it more, so people will pay more, okay, and you get a dividend, okay. So we want to look at the earnings per share on that stock. And so for CVS, okay, they've got they've got $2.20 in terms of earnings per share. And let's click on this. It's B35. Okay, that's the average number of shares outstanding divided by, okay, B33 divided by B35. In other words, the earnings per share equals the net income divided by the average number of shares outstanding. And again, we could have used the formula bar and put those in, used the name manager and put those in. Here's CVS. It has 990,000 shares outstanding, okay? And the earnings per share is $2.18. So when we stop for a moment and say, okay, what am I getting here? Okay, what am I earning? They're pretty close in terms of the price of a share. And for most people who invest in a company, they buy a share or portions of a share or what in a company. Okay, so there's not much difference here. And it's interesting because if you look up here, okay, you've got their gross incomes fairly close. Their operating costs are kind of close. Their total expenses are fairly close. Their income before income tax, that's a big one. Income tax expense, net income. Okay, so if I was just basically concerned about, what am I getting? Earnings per share, or also known as EPS, I'd be asking a question. Now I come down here and I see the price per share. Okay, and the price for CVS is $28.74. Okay, the price of Walgreens is $36.93. You say, why would they be different in price? It could be a variety of reasons. Okay, and it typically is something that people see in the balance sheet of a company, not the income sheet. Okay, and you say, well, let's see about that. So we walk down here, we see the balance sheet for CVS, and we see their assets, the current assets, and then we see what are known as their fixed or their fixed or long-term assets, and that gives us the total assets. So total current assets for each firm. Now, those are comprised of cash and equivalents. Current asset is anything I can dispose of within a year and get cash. Then long-term assets are like net property and equipment. Goodwill, that's my trade name, what's it worth. Intangible assets, that might be, do we have a special algorithm that we use to know who's like when they come to our CVS website? Do we have some kind of new technology, whatever? But some type of, it's usually an intangible type of thing. All right. And then it can also be we have more highly trained, better educated employees. There's a range of those things. So then we come down to any other assets and we get the total assets. Okay, and that's going to be right there. Now let's scroll on down here and we come down to the liabilities. And we see, okay, what type of short-term borrowing have they done? Trade accounts payable, okay? Do they owe money to other people? Do they owe money to a pharmaceutical company, or maybe if they're leasing their building, those kinds of things? Then the claims and discounts payable, okay? And then the accrued expenses, and then any other liabilities. Okay, and then we come down to the current portion of long-term debt. You say, what do you mean by that? If I have a long-term debt, okay, like a mortgage, or I borrowed, or I've issued a bond, the current portion of the long-term debt is typically either going to be the interest I've got to pay somebody who's a bond holder for a bond I've issued, or it's going to be the interest I pay, say, on a mortgage, okay? And And so that's the current portion of long-term debt. Obviously, the long-term, the non-current portion is the debt itself, how much you borrow. Okay, so now we have the current total current liabilities. So we got total assets, total current liabilities. Okay, and we can come down here. You say, you really didn't use the name manager very much. No, I didn't, but you could if you wanted to. And I've left it like this. There may be some of you who want to go back in and try that. I don't care if you want to upload it, but I want you to see the name manager and what we could do with it. But we're going to see this in just a minute when we do the ratios. And then I've got long-term debt. See, they owe 8 millions or 80 million, and their interest is running $653,000. So there's that long-term debt, and there's the current portion. Then they have any deferred income taxes. Okay. The company, if it owes income tax, can defer those taxes out over up to, I think, 5 years. You can only do it once every 5 years, if I'm not mistaken. The government will just say, well, we all hope we had a fantastic year. We didn't have the expenses we thought would offset. So but can we pay this out to you over 5 years? And the government will go, sure. Okay, but understand, you take this, make sure this is the one bite you get, because you won't get another for 5 years. And the government recognizes that companies, will sometimes end up owing a lot of money because they're growing and they haven't got, and they haven't, and maybe they haven't had the timing of things that would reduce their debt, like interest payments, or that would reduce their debt, like not their debt, but would reduce their tax liability. Things like depreciation just haven't matured. Then we got other non-current liabilities, and that gives us our total non-current liabilities. So we've got total current liabilities plus total non-current liabilities, and that's equal to our total liabilities. Now, here's something fairly striking. When I look at CVS, they've got 26 million sitting out there, or 260 million and then we've got CVS who's sitting over here at these are in millions. So I'm looking at 95 million. Then we come down to shareholder equity, and the total of liabilities and shareholders' equity for each company. Now, this is an important juncture, important point. The accounting equation is this: assets equal owner's equity plus liabilities. So the assets of a corporation belong to the people who it has borrowed money from via trade credit, the issuance of a bond, anything like that, plus the money that the shareholders have put in. So it doesn't belong to management, okay? And it doesn't belong to anybody but the people who've invested in it. And so, and you have to understand, and when you understand that, then you understand a company's not an ATM machine, okay? Although a lot of them try to act like it. A lot of boards of directors and CEOs out there do anything but honor the morality that's inherent with the accounting ratio. And there's a morality there, and it says somebody loaned you money, somebody invested in you. The assets that you have in this company are a product of those two. Okay, and that's going to be the same for whether you're a multinational corporation or an entrepreneur, a small entrepreneurial firm, a proprietorship. Okay. Well, now we're going to go up here and you say, you've made so much about the name manager. Where's the payoff? Well, we're going to see that here. Okay. And now we're going to go in and we're going to compare these companies on the basis of their ratios. And we're going to start with the current ratio. And here, notice what we've done. We use those two. If you look up in the formula bar, you're going to see CVS current assets divided by CVS current liabilities. Do they have the money to operate? Okay. And then we have Walgreens. And we have Walgreens current assets divided by Walgreens current liabilities. And then we have the quick ratio or the acid test. The quick ratio or the acid test ratio is mentioned, I believe, over on the bottom. Pardon me, it's over, yeah, it's over on page 48. It's also known as the acid test. It's also known as the banker's ratio. And here's what it says. I'm going to really know how much cash is on hand, okay, I'm going to take the current liabilities, that's cash or what I call near cash, that can be things that can be converted to cash. I'm going to subtract the inventory because that's stuff sitting around. Somebody may not want it, or I may not be able to get anything out of it. Divide by the current liabilities. So that one's the one that people often look at that's a little bit more important. Now, Walgreens has a much bigger current ratio, but they also are carrying a pretty hefty amount, and probably carrying a pretty hefty amount of inventory. Okay, so now we come down to the total asset utilization. That is the assets that people put into the company, the equity, okay, and the liabilities. What's it generating? How's it doing? And if we look at, we're going to see CVS is doing pretty good, but Walgreens is doing much better. All right. So, and if you think about this for a minute, you say, oh, so are you saying that Walgreens does a better job of taking the money and the resources it's given and turning it into sales? Absolutely. So, and you'll notice here, I've highlighted in yellow the firm that has the better ratio is in yellow. If they're tied, it's all white. And you can see here Walgreens is better on that ratio. Walgreens, and they're tied on debt ratio, which is interesting. The return on assets, okay, Walgreens is twice as good as that. So while Walgreens may not have the massive amount of sales that they have over at CVS, they're doing as good a job with the money they're given. Again, you remember we talked about scale. Scale is everything. And then if you move on down here, we see the return on assets, the return on equity. That's one that people look at really. So if I'm buying shares of this company, I'm now an partial owner of it. I want to know, what am I getting for my equity? And then we see the profit margins, which are the same. And then we see the price to earnings ratio, and Walgreens just blows it right out of the water versus CVS. So on that basis, I might say, given these two firms are both pharmaceutical companies, they're retailers, they operate in pretty much the same industry, okay? Based upon what I'm seeing here, when I scrub the data down and turn them into ratios, real numbers I can compare things, I can do comparisons with, I'm probably going to be predisposed to go to Walgreens and buy their stock or recommend their stock, just simply because I'm seeing better financial performance out of Walgreens than I am out of CVS. Okay? And so that's how we use those ratios to try to understand when we want to compare a couple of firms. Now, just for kicks, okay, I'm going to diminish down my spreadsheet. I'm going to open up a new tab, and I'm going to go over to Yahoo Finance. Okay? I'm so glad to see so many of you are here today. Good. It's good. And I'm going to go to Yahoo Finance. All right. And of course, the Dow's going crazy. And it's going nutty. And I'm gonna do a search for CVS. There are some other great financial sites that will show you what's going on with companies. I could teach you an entire course on nothing but using Yahoo Finance. And I think it's Motley Fool. I think it's Motley Fool is the other website, and then Bloomberg is another website. There are a lot of websites out there that do all of that. okay? And you can see all kinds of data for for the for these firms, okay? Sector highlights. I mean, it's incredible all the information that's out there. Okay. Now, I'm certain as you look at these, you see the Dow Jones and the S&P and all these are down. Look, before Monday, the stock market has been hitting record levels every point. There's a certain point in time where whatever goes up has got to come down. Now, people start selling off stocks, and you're going to hear the people on TV or wherever and giving you all kinds of explanations. But what it really comes down to is, are people comfortable with what's going on? One of the issues that's in the mind of a lot of investors is, okay, probably the primary question in their mind is, will the Fed raise interest rates? And if they do, how much and when? If it costs businesses more to borrow, it costs them more to operate. So they get nervous. Everybody's always watching, what's the Fed going to do? Some of this might be tied into with tensions, particularly the tensions that are going on with North Korea. Some might be the tensions that are going on in Washington. On February 8th, Congress has got to come back again and determine if they want to keep the government running. Okay? And if they do, then they'll borrow some more money to keep it running. And they're going to run into the same thing again in March. And so there's this, again, we're almost at the fear of a government shutdown, okay? And it upsets the people on Wall Street. So we got some stuff flying around that gets people kind of rattled, okay? And I want to take this for a moment to talk with you about something that's very important. If you have not enrolled in Dr. Reader's financial, I think it's called financial planning course or financial management, or, pardon me, personal finance, do so. Wouldn't it be kind of stupid for you to know how to handle everybody's money except your own? Okay. Now I'm going to go back here to the spreadsheet for a moment. Okay. And I'm going to show you something quite interesting. I bet if I were to ask many of you, could you live comfortably on $200,000 a year? You'd say, oh yeah. So I'm going to put in 200. Okay. Now, in order to draw 200 a year, to have it almost be like an annuity, a guaranteed, you're going to have to invest it in things that are such a safe bet that they're not going to earn you much interest. There's a thing called the risk-reward paradigm. The higher the risk I get, the higher the reward. The lower the risk, the lower the reward. And if you put money in the safest things like treasury bills, U.S. Treasury notes, securities, historically you're going to earn about 2%. Now, if you want to know how much money you need to have in your nest egg to draw 200 grand a year and never touch the principal, you have to use what we call the formula for an annuity. An annuity is this. It is a fixed number of payments at a fixed amount over a fixed amount of time. You can be, if you have a credit card and you own it, you're paying the credit card people an annuity. That's why they send you a minimum balance every month to pay. Or your parents, myself, other people, draw an annuity. They're in their savings from their personal savings accounts or their 401ks, whatever. I'm going to show you the formula for an annuity, a perpetuity annuity, one that just never runs out, and it's going to equal the amount of money you want to earn every year to live on, divided by the interest rate. And I'm going to go over here and I'm going to put this here. And you're going to have $10 million in savings. Okay? That should put things in perspective. So as I talk about this course and these financial ratios, this one particularly, I really want to get your attention that you need to learn to start saving one way or the other, okay? And you need to learn how to handle your finances. So I suggest to you, please, I'm begging you, take Dr. Reeder's personal finance course. Maybe you've had Financial Peace Industry, Financial Peace University, fine, okay? But understand that. Now, the other thing is, be an investor who's consistent. You say, what do you mean? Let me take today, where everybody's panicky about the stock market, okay? Now, 90% of what I have in terms of all of my annuities and savings is in fixed income, guaranteed income kinds of products, okay? I don't get much of a return on them, but they're safe. The other portion is in stocks. And so while everybody's going crazy, okay, I'm happy because what that means is I'm going to get some stuff cheaper than I would have last month. And then as I hold on to it, it's going to grow. And I'm going to slip it into my fixed income and I'm going to make a profit. So right now, if I was a billionaire, I'd buy up everything I get my hands on in terms of the stock market because it's going to go back. And we also have to put this into context. A drop in the Dow of 1,500, 1,200 points or something like 1,300 points, the stock market was at 26,000. That's a 4% loss. Okay, we lost, and that's just 4% of the size of the market. Now, back at the Great Depression, if I'm not mistaken, I think the Dow went down 300 points. But at that point, the Dow was 900 when it hit its height, the 8 or 9. So there was a chunk. It lost a third of its value. We're not there yet, and I don't think we will be. But this is a good time for you to start thinking about that. Even if it's $20 a month, if you can do that, start saving. And when you go out into the world and you go to work, and your employer offers you a retirement plan, participate. Okay? Well, that's the end of that sermon, but we've seen several things. And again, this is a nice output area over here. You can see I've got it barred off, and we've got a way to do to compare these. And on the basis of these ratios, I would probably say I'd buy Walgreens because it's performing better. It's doing less with more. Okay, and I'm looking at the fact that, first of all, even though it has far lower net sales, okay, its return on assets and return on equity is off the charts, and it has the same profit margin. And it's a lot harder, my friends, to generate $87 million in sales than it is to generate $59 million. Okay, now I'll diminish this down one more, and let's put CVS into a little bit into their into perspective, and they're selling right now at about $73.50. There's their PE ratio, price to earnings ratio is 14.98. When this case was designed, the PE ratio was 12, so they've improved their PE ratio considerably. Okay, so we started a little bit better today, a little bit early today, and so we're back at this point now. I'm going to take some time here for just a few minutes, okay, to kind of keep us on an even keel, and we'll get that out of that. And let's look ahead. And again, people say, okay, what's the quiz number for? What is it over? As I've said many times, quiz number 4, the financial ratios quiz is drawn primarily from case number 4, Dabney Financial. There are also some other other resources that are out there, and I'm going to show you here for just a minute. I'm going to go to the modules section. And one place you'll find them, I have the brief history of accounting ratios. That's over in the files. Okay. And then I'm going to go over here in the welcome area, that module, and I'm going to find the supplemental website. And you'll want to take a look over here. Okay. And you'll probably see some things that might be of help to you in terms of accounting ratios. And always remember, I don't have any problem at all, okay, because it is open book and open note. I have no problem at all right, if you choose to do an internet search to try to help you out as well. I don't have a problem with that at all. I'm good to go. Okay, so we have XLS1 and XLS2. You should have those uploaded already, as well as XLS3. You got the financial ratio quiz coming up on the 8th. And I think I have it set for 7 p.m. or 5 p.m. Let me see what I got going on here. Yeah, sometimes I have to, yeah, okay. Yeah, and again, it's 20 minutes. You get 2 attempts within 20 minutes. I think there's, let me preview it for a minute. I think there are 10 items, if I'm not mistaken. And there you go. And you can see the kinds of items in there. Okay. All righty. Now, when I come back on Thursday for our class on Thursday, we'll take a look at case number 5, XLS case number 5. Okay. And I'm going to talk about it for just a moment. That's the town of Clintwood. And this is a city, we're going to be working with a city budget, and we'll be doing a little bit of extrapolating. You got a question here? Let me try to answer it. The case we're working on today, Dabney Financial, is case number 4. How do I know? If you have your textbook with you, the Solvent textbook, in the table of contents, if you come down to chapter 3, the spreadsheet management software cases, you'll see case 4, Dabney Financial Services. Okay, so we're working on this. So you say, can I upload this for case 4 and have that out of the way? Absolutely. Okay, and again, you can always, if you want to, play around with the skeleton files that are over there in the file system. You say, what are you talking about? Let me show you here real quickly. But don't do it to the point you miss getting the points for doing the workshop. And always make sure you log in. Here are the solution files. Here are the student files. So when you hear me talk about the skeleton files, that's what I mean by these. So if you wanted to play around with it, do so. And if you upload it, and it's, I don't go through and pick through each one of them. I just see that you've uploaded either the key, which I showed you today, or you've uploaded something else that's work you've done trying to work on just for kicks. Okay. But and so you should have cases 1, 2, 3, and 4 all uploaded, ready to go. They should be uploaded. This is case 4. Okay, and again, it was Dabney Financial. Now, case 5, which we'll work on Thursday, is Clintwood. Okay, the town of Clintwood, and in that one, we're going to look at a city budget. We're going to do a little bit of looking at scenario management and talking about that, and how we can do some extrapolating and some trend analysis. Okay, well, I started a little bit early, and I'm going to go ahead and close this off here, and this will pretty much do it for today. And then on Thursday, I'll be back over, and we'll work on case 5. So And let me say this one final thing, everybody. Remember this: Monday from 2 to 3:15, this course is taught. Thursday from 12:30 to 1:45, this class is taught over at Shawnee ground-based. So if you were to say, Dr. Harmon, I really just want to do this ground-based, okay, I'm more comfortable just sitting in the classroom, fine. If your schedule allows you to make both of those ground-based sessions, I have no problem if you're in a different session. I don't care. Sometimes it's a little bit crowded, and one of the reasons we've gone to this of hybrid format is just not only the things I've talked about, but just simply because sometimes we have so many students that want in these courses that we really just, the only way I can sometimes make it manageable is to do it with a hybrid, and it's just kind of grown with that. I think I've got 35 or 36 of you are in one section, 30 some odd in another. Okay, but Thursday will be the ground-based section of our course. Okay, and of this section, Thursday at 12:30, and we'll go over case number 5. Okay, I had the ground-based part for the other section of 1123 yesterday. Okay, and so you'll want to look at the Solve It textbook. You'll want to look at the town of Clintwood. All right, and if you look in the files, you'll either find it in the Solve It 6.0 solution files or XLS5. Okay, or I may even have one called Clintwood, but I think it's just the XLS5. Okay, so that'll pretty much do it, folks. Thank you so much, and let's see if I have a Clintwood up here. I might. I don't, but I do have a case number 5. So that'll do it, and thank you for your time. And so many of you who participated, good to see this. And I'm looking forward to seeing your work and looking forward to seeing you do well on that financial ratios quiz. So I'll see everybody Thursday. Thank you so much. Have a good one.